Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle, and welcome back to Canada after a nice vacation in Europe.
Well, it was a working vacation, Jim, but it was good. And as I said to you, I crossed the bridge in Genoa 2 weeks ago, so I'm very grateful to be home safe and sound.
So, a working trip in Europe, what kind of lessons did you bring back home?
Well, we were doing a lot of research on credit markets, realty markets, valuations in that neck of the wood, policies. I think probably one of the facts that I confirmed, which I'd already had a considerable understanding about, is just the magnitude of the debt crisis over there and how that's playing out in different countries. For example, that Italy has really, the bridge collapse is really indicative of sort of a degradation of the infrastructure of that country in general. I know the bridge was built in the 60s and there was various reasons for that, but that is the fifth bridge to collapse in Italy, I think, in the past few years. And their environmental degradation is quite evident compared to, for example, places like France, where they've brought in along the French Riviera, for example, in the last couple of years, they brought in taxes on all the massive yachts, port tax, because there's a good deal of pollution that's coming off of these massive yachts, which are typically registered in tax-free havens like Jersey or, the Cayman Islands, that sort of thing. So they're very much, Russian oligarchs, Saudi princes, all this sort of thing, with whole teams of staff that live on board these ships and keep them at the ready. They have helicopters coming and going off the back of them at all times. I was kind of witnessing all this firsthand as opposed to just reading about it, which I've done in the past, but also the fact that they brought in these port taxes and what that had the effect of was driving many of the yachts out into places like Italy, where, for example, they have minimal to no port taxes in many stops, but yet they have much higher pollution levels in those cities, like Genoa, as an example. So the forces that have been polarizing wealth around the world have been global, and you see evidence of it everywhere that you go. Money basically on the lam, running away from tax zones, and yet the cost compounding. Another thing we were witnessing firsthand was the obesity rates in the healthcare costs, the healthcare systems in many of the European countries. Pure observationally, they have a lower obesity rate there, almost half of what is evident in the United States today, and 10% less than we have in places like Canada. And the reason for that is quite obvious. Their food system is still largely local, largely fresh, very little representation from your highly processed food companies like McDonald's and fast food outlets of that nature. And so people still in major cities go to fresh markets from the countryside, 2 times a week. They still do a lot of walking and biking. But primarily it's the food. And so that's interesting to confirm, again, because as I wrote on my blog this week, it was really, in countries like France, it was like walking around, how we used to look here in the 1980s. It was shockingly obvious that people were much more regular in their body mass, especially the young people and teenagers, where here you would see 4 out of 10 perhaps have a major weight problem already developing, and all the health complications flowing from that. There you would see, maybe 1 or 2 out of 10. So very visible in the population.
Do the kids there play video games like they do in North America?
Yes, they do, and that's certainly part of it. There's everywhere you go in the world today, I've noticed this repeatedly, is everyone's head is down. They're looking at phones, whether they're riding bikes, motorcycles, driving cars, on the Autobahn. People are on their phones, and it's a horrifying, dangerous situation. There's no question. But even then, even with that, epidemic, which we have to really push back on in curbing that obsessive compulsive behavior, because it's really becoming such a menace worldwide and impacting our productivity worldwide. But even then, you can't outrun a bad diet. Essentially, no matter, whether a person is active, whether a person gets off their couch for an hour a day, which is considered active these days in the developed world, whether you go out and walk in nature, if the food you are consuming is, poor nutrient, high calories, high fats, even empty carbohydrates, you really can't keep your body weight and your health in your system within normal limits. So it's much more a function of food than it is activity, believe it or not.
Yes, and I found it very hard to go anywhere and find a good salad.
Yeah, and a lot of places their idea of a salad is some, iceberg lettuce thrown in a bowl and maybe a piece of radish with some really nasty dressing. So yeah, there are. The fresh food movement is alive and well all across Europe, much more so than I find in North America, although we are having a resurgence here as well. I think there's an awakening generally in the world, a consciousness about how far we've gone off the sort of not just sustainable path in terms of the food system, but also off the health path. And there's pockets and pods of people all over who are really, pushing back and trying to bring back education about food. And I think that it will succeed because the current system is inherently unsustainable and unstable and unaffordable financially for all the systems, the tax bases, that are trying to fund it.
Well, I found it interesting. The last time I went to a farmer's market a few weeks ago, all the organics were sold out like in a few hours. People want it.
Yeah, people want it, and mostly, there's the realization that much of our seeds are already spliced with, things like, Roundup and products like this that are supposed to kill off bugs, but are actually doing dramatic harm to our DNA at a cellular level. And there's a direct connection between the infusion of that into our food system and our water system and the dramatic spike in incidence of things like dementia and autism and cancer and all that. So, it is far and wide, it is worldwide, and it's interesting that Monsanto was in the throes of selling itself to Bayer, as all these sort of the new wave, and I write about this on the blog quite a bit, is I really sense a new wave at work here. And, we've been through this wave of corporate profits on a dramatically escalating level over the past few years. We've had a softening of regulation, a softening of prosecution for offenses. We've had at the same time a increase in the amount of influence that corporations have had over government policy and politicians, over the tax system, over what's been, a falling tax environment, increasing write-offs. All this stuff has really gone all in favor of corporations, and their profits have really been very fat in response, which is understandable. But what's happening is we're looking around the world and seeing all the carnage that's happened, and whether it's again to the natural world, to people's health, to the water system. For example, the opioid crisis. Today in the United States, even President Trump had a moment of clarity and directed Jeff Sessions, his attorney general, to start a federal prosecution, a federal lawsuit against the opioid manufacturers. The United States is succumbing to an opioid crisis. It's an epidemic. It's undercutting productivity. It's decimating families and the social fabric. And, the companies who have grown rich on making this product are indeed the drug companies, just like the Monsantos of the world and the chemical companies that have made all of the things that have infiltrated our food and water systems. So, now it's where you've got a lot of IOUs and drawers all over the world. You've got a lot of very threadbare cupboards, whether it's in households, in governments everywhere that have been trying to fund all of the increasing social costs of this while they're tolerating the falling tax base from corporations. Now you see a turn happening, Jim, and this turn is people following the money, right? They're saying, okay, fine, if everyone's broke and everyone's in terrible shape here, someone's got to pay. Someone's got to help us rebuild. And how are we going to fund this? Well, we're going to have to go after the people who made the profits creating the harm. And so you're getting, whether it's children's groups suing, fossil fuel companies in the United States, which was recently, the Supreme Court recently rejected the government's request to throw out the lawsuits. They said, no, there's no case to stop this process. Whether it's that, going after the harm for the environment, whether it's the harm for the opioids addiction, it'll be going after the smartphone makers for all the carnage that's happening from the addiction to the applications and phone systems. And yes, you could say that individuals have a role to play here and that they should have personal responsibility. Absolutely. But again, who's going to fund the cleanup of all this stuff? That is the issue. And if individuals have been, run into the ground with the buying the debt bomb and spending their brains out on things that have actually ended up harming them, you can bet your bottom dollar that we're going to see a rise in people going after corporations, just like, for example, the emissions scandal. We're going to have a rash of lawsuits. Already they're spreading. All the major car companies are being sued now by people who bought those vehicles on the premise that they were cleaner, and in fact they have been polluted 40 times the rate that people were told. So now you're seeing a rash of lawsuits, class action, and otherwise going against the companies that made the profits. So I think this is all part of this self-correcting mechanism. We definitely have to have more accountability. We have to have the harm, the cost of the cleanup and the harm going back to the people, connecting back to the people that made the profits, and that will be the sort of equalizing force that we have lost so desperately in the past couple of decades.
We'll have more with Danielle Park right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Danielle Park. Danielle, in your blog, you said companies should be more accountable to their employees. And I'm just thinking of the Sears bankruptcy where the people are being told your pension fund isn't going to pay you what we said it would, but yet the remaining executives are getting huge bonuses.
Well, this is just another example, right? So Elizabeth Warren made good news this week when she proposed a new bill which she's calling the Accountable Capitalism Act. And it's not just the Democratic creation. There's support for this notion on both sides of the political spectrum, where there's just a realization that corporations have had a hell of a run, ever since really 1980, falling regulation, falling taxation, and just increasing clout and control over politics and policy. And so what's happened is we moved from, in the early, I'm just writing about this in our month-end letter for clients, but in the early ideas of a corporation, it was really, monarchs and people trying to raise money for foreign expeditions that would take in money from shareholders and, spread the risk, and then people would share in whatever spoils were brought home, that kind of thing. And it was an inception, a recognition that there are various stakeholders, and as time went on, as corporations spread, as they came to the United States, particularly in the 1700s and then thereafter, it was really part of the massive, the industrial bonanza that went on in the United States at the turn of the century, where corporations had a role to play because they were able to bring a pool of resources to fund important infrastructure and development that had to go on in the country, that was able to create jobs, that was able to pay tax, that was able to get things done for the greater good of the country, of the nation. It was they were partners in the nation building process, and that was really a premise. This idea that there was many stakeholders. There was, lenders. There was governments who were to collect the tax. There was employees who were to contribute their labor and receive compensation for that. There was customers. There was, the end result to society, the benefits. All that was part of the puzzle up until about, it was sort of in the early 80s that the movement started to go away from that. And Milton Friedman was a famous economist who wrote an article in the sort of latter part of the 1990s about the idea of maximizing shareholder returns as being the only obligation or the only goal. And within about a decade of that article, businesses really went full circle. Management, boards, everyone really bought into this idea that, they didn't have a duty to employees and customers and lenders. They had a duty to make sure that share prices went up, right? And they shifted the compensation packages of the executives away from longer term goals to really a very narrow focus on make sure that the share price goes up. So they did that by compensating giving them big bonus packages in the form of shares. And so all the longer term thinking was really thrown out the window and focused on how do I get quarter over quarter, improvements. And that turned into a culture of financialization that's really been a very devastating chapter in this whole history. It's only been, as I say, about the last 25 or 30 years that it's got into this whole belief system. But now we've got the wreckage far and wide to show for it, and we're really, the pendulum is swinging back, as I began to talk about at the start of this conversation, toward this. We have to go back, follow the profits to clean up the mess. We have to get greater accountability. This economy is not serving the general population. It is increasingly only serving, a minimum amount of the already rich in the population. And I'm not talking about the 1%. I'm talking about a tiny fraction, of the people who own these lumps of shares that are being sold, that is being compensating them for their work, and egregiously compensating. I mean, the average CEO pay of a big company is now like 360 times the average worker in North America, primarily in the United States, but Canada too has really gone along for this ride. Compared with like 42 times in 1980. And this is not about, we don't want people to be compensated for their effort. It's nothing to do with that. It's the fact that the way that we have structured this thing is devastating for all the stakeholders, even for the businesses themselves. The level of endurance of companies, it used to be, decades and longer, and now a company is lucky to last 15 years because, they're constantly gouging out the cash and the balance sheet to pump up the income statement, to pump up share prices, which are by their very nature a non hard asset. They rise and fall with the business cycle, with the credit cycle, and once they crash, you realize you've wasted all the funds on something that was not actually tangible. And so Elizabeth Warren's proposing this bill at the same time that there's much talk about bringing back the ban on share buybacks, because this is another financial gimmick which has preoccupied the C-suite the past few years, taking them away from long-term research and innovation, taking them away from investing in the workforce, all about just how do we get the share price up. So we've got an asset bubble now worldwide. Financial markets have totally disconnected from the reality of, what the sustainable growth rate is in the economy, or what the affordability is of people that are working and living. And now we'll have to have a reconnection phase, which means asset prices will come down, legislation will come back in that is not in favor of not only in favor of corporations increasing their profits, but making them pay for the harm and connecting it back to what effect they're having on the general, fabric of the place.
We'll have more with Danielle Park right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Danielle Park. Danielle, most people are saying the markets are due for a major correction. What if your finances are so tightly tied up in them that you're looking at a crash, and if you're an older person, that's going to be your retirement funds? What should you be doing right now?
Yeah, so it's this is another damaging side effect of this era we've been in, where central banks have suppressed rates so much that savers who would normally be risk averse, and appropriately so, because they have amassed their life savings and they can't afford to lose the money, and they were, expecting to live on interest collected from the deposits, were facing zero and almost, minimal interest income from their savings. And so what they were recommended to do, what they were encouraged to do, was to buy these volatile financial products, mostly built on things like corporate debt and equities, which were, nominally paying more in terms of income. But if your capital is at grave risk in the income while you're collecting that income, it's a very inappropriate trade-off for most people. And it may work for a while, but when the price comes back down, they're left devastated because they couldn't afford to lose that money. So that's really where we are today. People have been sucked in. This has gone on much longer than, the markets began to turn down in 2011-12, if you remember, Jim, and it was the QE, it was the European central banks will do whatever it takes. It was throwing all that good money after bad that re-levitated asset prices globally, but really didn't do any favors to anybody because wages did not keep up in any way, shape, or form. They've really flatlined. So people have not got wealthier. They've just had the appearance of gains in these asset prices. So, the writing has been on the wall for a very long time here, for several years. The warnings have come in. There was one in 2016 when these income-bearing instruments crashed 25% in a matter of 2 months. We have seen them selling off again in the last year to date. We're seeing warning signs from commodities, the commodity complex. Much of the industrial metals and, even oil's been selling off dramatically year to date. There was a market high back in the late January, early February in terms of the stock market, and it's still not been able to best that high with a lot of gyration between now and then. All those things are classic late cycle signs where you've been warned time and time again. If you're still holding those instruments thinking that you're collecting income and getting away with something, there's going to come an abrupt awakening here where they, as we've seen in the last two cycles, lost 40, 50, 60% of their value, and the dividends you're collecting will be insufficient compensation for the psychological, emotional trauma and financial loss you're going to feel when this thing mean reverts. And so, that's not like trying to be doomsday. That's just pragmatic recognition of the way these cycles have moved and how they've been unduly pumped up with all the factors we've talked about. So corporate revenues have been at an all-time high. Corporate profits have been at an all-time high, and we've paid an all-time high multiple of those corporate profits on the equities that they've been selling to the public. So what you're going to see is a contraction of profits because, as I say, no profit run goes up indefinitely. Neither capital nor labor gets it all their way indefinitely. These things are mean reverting, and when profits cannot be any higher, they begin to come down, and when labor has been, beaten into the dirt, it begins to come up, and this is just the way it goes. So what's the problem today is that these assets are not only, you're paying a huge multiple of these earnings, but the earnings themselves are in jeopardy of a dramatic contraction, in which case you're going to find that the assets were, they look crazy valuations now. Imagine what it'll look like when profits have come off substantially in terms of that metric. So it's not too late for people to take defensive steps and to step back from risk, to look at more secure places to put their deposits. GICs are still good. Government bonds, Canadian government bonds in particular, are still a safe haven. U.S. Treasury bills are a place the world goes to. We're seeing a great exodus out of emerging markets right now and emerging market currencies because they are falling dramatically relative to the U.S. dollar. They did this in 2008, Jim, if you may recall. At the beginning of that crisis, the flows started to leave the junk debt and the emerging markets and move back into, Canadian and U.S. government bonds and Treasury bills, currency in the U.S., and that is likely to happen this cycle as well. So, you have to look for places where you can kind of wait out the mean reversion process, and then you can look for how do I, what can I buy after the storm when things have come down significantly in price and everyone's desperate for cash. That's when you want to be sort of picking through the rubble to figure out what you can add that will actually, not give you ridiculous amounts of risk, but will give you a higher income.
Some housing experts have said that we could see a 30-40% drop on the Canadian real estate market. What's that going to do to the economy?
Well, you see, again, people say, oh, you're being so doomsday when you say that. That no one's being doomsday. They're just saying that in every other cycle in history, in the world, okay, because human beings behave the same way no matter what country they're in, pretty much, especially around credit. We've got thousands of years of evidence of this particular behavior. So when you have had this dramatic and overshoot in valuation, a spread of, 8 times income for the average home price, which is where we got in many cities and like Vancouver and the Greater Toronto area in Canada as an example, the long-term average is 3 times your average household income, the price of housing, and that's what people can afford. When you got 7 and 8, that's not what people can afford over a long time frame. They can only afford that if they're able to continually roll over at cheaper and cheaper financing, or keep renewing their loans and robbing Paul to pay Peter and all that sort of thing. So what that means is that you get the prices come back down, and the money, if you didn't sell at those elevated valuations, that money basically never was there. And the people that bought at the elevated valuations typically end up selling in panic because they can't afford to keep it now that they have no equity. So it's as we've talked before, the Canadian economy has become unduly concentrated on housing, construction, real estate fees, transaction costs to do with real estate and finance. That's really been the bulk of what's driven our economy for the past several years. And so, yes, it's going to be painful when that is no longer the wind at our back, but more of a weight on our feet. And we've been telling people for some time, if you have superfluous real estate, that negative cash flow real estate, God forbid, where you bought something as an investment thinking it was an investment, but you can't actually rent it out for enough to cover its costs. That is the kind of stuff you should run from, right? You should just sell that and downsize your risk and exposure there. Because negative cash flow was never a good investment. That was a speculation. That was a hope that you could buy it and sell it to someone at a higher price. That had nothing to do with investing. And some people have borrowed against their homes in order to buy properties like this. So that also was never investing. That was always reckless speculation. So, these are the things where you have to be super aware of the choices that you've made and what it'll do to you if you're not prepared as this cycle turns. So it's going to be difficult for our economy, but it'll ultimately be cathartic, and we have to have this cleansing process. As I say, pendulums swing from one end to another. We've had it very extreme in one direction of financialization and wasting money, good money after bad, not investing in long-term sustainable practices and building up cash flow and balance sheets and households and businesses. We have to get back to all that. And when we do, we'll be in for another boom, and it'll be probably, within the next 2 or 3 years we could see that boom begin. But it's getting from here to there that the difficulty remains. And until we clean house, so to speak, until we get things, repriced for reality, it's just a stagnant thing that kind of sits there and doesn't do anything productive.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HoweStreet.com radio. Find us on Twitter at HoweStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.